Right, rate of inflation. And this has been interesting because a couple of the times the Fed has come out with information in the last really month or so, it's been perceived as positive, but I'm not so sure it really has been. What I think is really interesting is normally the rate of inflation, at around this 2% is everything you buy gets more expensive. And that's just the normal rate of things. As we've had inflation going up to almost 10%, everything you buy gets way more expensive. But then when it goes from this, 9.5 to down to 8, everything you buy stays expensive, but the prices just don't increase as quickly as before. So the problem is prices are still going up. 8 is still way, faster than what it is in normal times. So we still have an inflation problem. So until that number gets brought back down really below 3 or even 4, we still have some issues that the Fed has to try to deal with. Every time they talk about how things are improving, I mean, they're not improving that much to get excited about. At least that's my opinion on these things. Our usual long-term data, our long-term trend of the advanced decline has weakening since the first of the month. What's interesting is it kind of had this trend line going here. I should have drawn it on here, but it really kind of broke then and has been really just messy and a little bit down so far this year. Back last time, I think we were here, we were kind of challenging this trend line and it did break through. So November ended up decent. And as we said last month, the expectations for December are usually pretty good, but I can see some reasons why it might not be. But then going into next year, we might have a positive year as well. But then that's all going to feed into what's potentially the lost decade that Will talked about last month. And I'm going to show a little bit more detail on that as well. So long term was positive but weakening. Midterm advanced decline, is money coming in or out of the market? It's now coming out. Even though today's a little bit positive, it's still showing negative. So that's not a real positive thing for the next, week, 2 weeks, maybe the rest of the month. I don't actually know at this point. It's interesting. Usually when the market's good, December tends to be good. When markets are not so good, December can be a little iffy. It can be flat. It can be a little bit down. The chance of it being positive aren't as good as they would be in a positive year. So that's where we're sitting. But as of right now, money flow is now negative, and we're starting to back out of our positions and looking at hedging and starting to play it safe. Not fully yet, but starting to really think about that if something goes wrong quickly. As we always look at positive sectors to negative, positive are 6 to 5, that has been weakening. It's been like one about every day or other day we've seen that happening and then shifting from positive to negative. Energy last month was negative and it's still negative. The trend is actually confirmed negative and has been for a while. Last month, a lot of these had been positive for about 30 days, and that's usually in this current year, it's about 30 to 40 days is the cycle, and then they start going the other way. So they did run out of steam. Now they're starting to get weak and moving to the negative side. MACD is more of our early warning. So we've got early warnings on basic materials, on consumer staples, and real estate. Industrials are still negative, but still holding up. I mean, like the Dow is too. I really think of that as the Dow, and it's doing okay relative to a lot of other things, but that could be weakening soon. I don't know. So far, that's holding up the best. And utilities and healthcare are also both positive and actually trending, and this is right on the verge. But yeah, we're seeing a shift from positive to negative, so I don't know if that's going to continue. Usually it continues until all the sectors are on the negative side, and then it starts going back, but we'll have to see if that continues or if some news comes out. If the Fed says something, I think they're talking next week, that could change this whole thing and push it all positive and have a great run into the end of the year. And the rotation graph, here's the energy way down into the lagging box. As we always talk about, this is just a mess. It doesn't seem to really know where it wants to go. It's all kind of pointing like it wants to lag, but it hasn't gotten there yet. Consumer discretionary is oddly in the leading, and that doesn't make a lot of sense because the two stocks that really drive that are Amazon and Tesla. And they're not looking great when you look at them on their own. So maybe there's something more underneath those two sectors. But typically, for the holiday season, that's where a lot of money flows. People are spending money for Christmas, being positive about that stuff. So that's usually a good sector in this time of year. But right now, if Amazon doesn't see that, I don't know. That could be bad. A good hint at how December might go if we don't see people spending money on Christmas. And then S&P, this really kind of, I thought fascinating, is you can draw a line across the peaks of this year. This is January, this was March's peak, this was the July-August peak, and then here's the peak right at the end of November. I believe it might have even been December 1st, and then it's just been back like that. The momentum trend down here has turned negative. That doesn't have to stay. You can see it kind of whips back and forth sometimes, but if it continues and persists, we could see another one of these. At the moment, bars are green, so that means where it is in the rotation is still positive, but that's something we look at every day, and if that turns orange or red, then it's like, okay, we're going to get out of here and play it safe for a little while. To add on to Will's lost decade thing, and this is so interesting to me, and this is really where I learned to be both an advisor and a trader in these kind of eras, really the 2010 era. And it kind of goes to the Shiller PE, which I used to show all the time, and I'll bring it back this month and maybe periodically next year. But anytime the PE ratio is up in this, historically back in the 60s, I think in the 15, this was a really high peak. This was the peak before the Depression. And then what happens is when you have these peaks, when you have the peak in 2000, this is a 10-year rolling, the green is a 10-year rolling return after we get these peaks. So in this era was negative returns. In this era, we had 10 years starting 2000 of negative returns in the S&P. And I'll actually show you a chart of how that played out before and after, because things are great running up into it. And then when this starts breaking, that's when things start falling. And then right here is actually 2008, and then that broke, and then that finished the decade, creating that part. And then since then, we've had a run up, and then this is starting to fall apart again. And that all plays into this scenario of another lost decade that probably would have started about a year ago. Definitely keeping that in mind, and that could make things really interesting or even difficult for some people who are doing more traditional thinking in their investing. Current Shiller PE, see there it is, it came down. That's really this year. Since it peaked, 28 is still really high. I put a line here at 15. That's kind of the line in the sand where things can stop and turn, at least lately. Historically, back when it got down to 5, that's when these new bull markets started. And then when it peaked, there was a peak, that's 1960s peak. This was a lost decade. This was a lost more than a decade. And then here was our 2000 peak down to 2010. That was a lost decade. So that's how they play out. So we've just had a peak. We're having a rough time. We could still see some ups and downs, but the projection is that over the next 10 years from last year, so 2031, we could still be in the same place where we are now. Here is the lost decade of the 2000. Here was the tech boom right here after coming off a great period of the 90s. Actually, the 80s were good too. It peaked here in the beginning of 2000, corrected in 2003, came back up, and then there was the 08 crash, and then really by 2012 is when we saw new highs in the market. I mean, that was a long time to go up and down and up and down before things got good again. And there have been some chops along the way. This was the 2018, which was a Fed issue that happened that fourth quarter. If you're doing traditional investing, you could be in for a really rough time. I mean, I think that's where proactive things like what we do becomes very valuable, is in this time period. And this is really where ShadowWizz was created, was understanding that these things happen, and you can't just be always invested all the time. And you've got to think about where when should you be and when should not be. And again, we're coming into a knot after a good decade long, from 2012 to now. That's been positive. So that's where we are. Hope that helps. And we'll see you next time.